Let's bring in our headliner today. Let's just get right to him. Tom Lee, Fundstrat Managing Partner. I might as well call you Mr. All In, not Jim, because you've been all in for what seems like forever. Are you still looking at 4,700 on the S&P 500 by the end of this year, Tom Lee?
Yeah, I know September was an ugly month, really tough, down 5%. But in the scheme of a market that could end the year at 4,700, I'd agree with Josh and all the other panels that that's just a squiggle. As we zoom out, it's going to look like nothing in 12 months. And I know investors are nervous and there's a lot of headwinds here. But as you know, when the wall of worry is big, that's also a good opportunity for investors.
I know, but why did we have such a bad month of September? I mean, it's seasonal. I get it, but it's more than that. And now we're entering what is also a typical tough month, and that's October. I feel like we're just brushing off what just happened in September as if it doesn't even exist.
Yeah, there was definitely a message coming out of markets in September because it really puts us at that knife edge of if you're half full or half empty. Are these inflationary pressures we're seeing signs of good demand, or is it stagnation? Is Washington turmoil something that gets resolved, or does it get worse into 2022, in 2024? Are we at peak everything? Is rising rates bad or good? I think there's a lot of questions. But to me, I think, and Jim mentioned this, and Stephanie, the fact that cyclicals outperformed in September, to me, is a really major signal. It says that economic resilience is strong. We're definitely seeing a mix shift in the stock market. And I think people are quite exhausted with COVID. And I think the fact that Merck does have a pill really does alleviate those concerns about vaccination penetration. And, it would be a very convenient and, as Dr. Gottlieb says, a game-changing solution. So it's a positive catalyst.
I get you. But, rising rates are in their own way a game-changing situation for stocks and multiples and valuations. And if they do start to go up, multiples are going to be depressed. We can't ignore all of the things that you just said are an undeniable positive, but they come perhaps with even higher rates than what we have now, anticipating an even stronger economy in the months, if not years ahead, once we can say, okay, COVID's endemic, but it's not paralyzing to us anymore.
Yeah, that's right. I know the market cares about rate of change. So the fact that rates have gone from 1.1 to 1.5 is concerning because it is a big basis point change. But 2 years ago, if we asked investors, is the S&P going to have multiple compression because interest rates are at 2%, nobody would really have considered that level to even threaten the bull market. 2 years ago, we would have said 4-6% would be the issue. So I think as people look at 1.5% today, or even 1.8 or 1.9 or 2, it's not really a level that burdens companies. It doesn't really burden homeowners. It doesn't really burden people with debt. And I don't think it should burden equity holders.
Now, you've been sticking with your call as well of stay overweight FANG. And those stocks have been tricky lately at best, right? They feel like they're in the midst of a last September, a year ago, weakness, right? Now, the market was okay because all of the other stocks did well. You get my point, right? There was a lot of slack to pick up the weight. And I'm just wondering if that's going to happen again. If those stocks weaken for a more prolonged period, what that's going to mean to the overall story.
Yeah, that's a great question, Scott. Last September, the overcrowding in FANG was significant because they were your stay-at-home play. It did save people's bacons to own FANG for not only 10 years, but throughout the pandemic last year. But in 2021, FANG's not as crowded a trade. So the fundamental question is going to be, are FANG margins at risk because rates rise? Our quant, Adam Gould, did a great analysis, shows that FANG operating margins actually could rise if rates are rising. And FANG's relative performance during inflationary periods is actually quite good. So I think we're fearing something in FANG, but because it's not as crowded, I think they have the capability to rally pretty strong.